I'm Richard Vague with Tychos, and today we're going to talk about central bank assets. In 2007, the book value of assets at the Federal Reserve Bank was $900 billion. But with the economic rescue efforts that followed the global financial crisis, both through purchasing troubled bank assets and executing quantitative easing, those assets reached $4.7 trillion by 2014. Most viewed this as a shockingly high level and argued strenuously that the Fed should shrink its asset levels back to the pre-crisis level through the reversal of quantitative easing, also called quantitative tightening. That never happened, and by 2019, all it had managed was to shrink its assets to $4 trillion. Then, in the pandemic crisis, the Fed again bought substantial levels of treasuries in quantitative easing operations, along with a lot of mortgages, and took the asset level up to $8.9 trillion. Those that had been troubled at $4.7 trillion were even more troubled now, and once again there were cries that the Fed had to shrink its balance sheet, and there has been some amount of that from the peak, but the level is still at $7.3 trillion. Part of the reason for the concern is the belief that high levels of Fed assets contribute to inflation, and shrinking the asset level is a necessary part of overcoming inflation. However, the Fed grew its balance sheet rapidly after the great global financial crisis, and Japan grew its balance sheet rapidly after its 1990s crisis, and neither of those events brought inflation, and in fact a broader analysis confirms little to no correlation here. Further, it is reasonable to think that the current level of Fed assets is not a concern. When we look at the Fed's assets as a percent of GDP and compare it to other major central banks, we note that it is the lowest of the group. Note that in the case of Europe, we show the total of the ECB, including the individual countries' central banks, such as the Banque de France and Deutsche Bundesbank. We can see that the predominant asset of each of these central banks is the debt of the central government itself. Historically, that's a primary purpose of a central bank, whether in Genoa with the Bank of St. George in 1407, the Bank of Amsterdam in 1609, or in the Bank of England in 1694, which can be considered the beginning of the modern era of banking. These banks were created to help fund and manage the government's debt, especially the large needs for debt that came with war, as well as the attendant issues of currency and interest rates. But over the last couple of decades, these central banks have also started to own other types of assets, especially private sector debt such as mortgages. As mentioned, this has happened as these banks have intervened in their, quote, lender of last resort, end quote, role, as when the Fed purchased a lot of troubled mortgage assets from banks during the global financial crisis. Fed ownership of mortgages after this crisis reached a peak of 10% of GDP, and as struggles arose during the global pandemic, Fed holdings of mortgage assets reached a new peak of 11% of GDP. Let's look at just the central bank ownership of assets other than treasuries, currency, and bank deposits to get a sense of this other asset ownership. This is primarily equity, mortgages, and foreign assets. This represents a somewhat expanded concept of the role of central banks. In the U.S., having acted in this expanded fashion in the GFC, the Fed was much quicker to take similar action during the COVID crisis. In our video last week, we talked about the surprising development whereby governments now own a lot of private sector financial assets. With this chart, we can see that central banks are increasing this type of ownership as well, though on a smaller scale. Although much is made of the need to have central banks as separate, independent entities from treasuries, the two, in fact, must operate together hand in glove. And in the past, including in the U.S. from 1836 to 1913, there was no central bank, and the U.S. Treasury had to perform, in essence, both functions and did just fine, thank you. In fact, this was the very period in which the U.S. surpassed both the U.K. and China to become the world's largest economy. So clearly, you can succeed without a central bank. So conceptually, at least, it's not inappropriate to add these two together, including in order to see what the total government ownership of financial assets totals to, including central bank ownership of financial assets. If we do that, we can see that Japan's government owns the equivalent of 17% of all the private sector financial assets in the country. China owns 29% of all the private sector equivalent financial assets in that country. Even in the U.S., where we can see that the government is the most hands-off, it owns 6% of private sector financial assets. It's an important thing to be aware of, not just because of its impact on the behavior of governments and the potential conflicts of interest of ownership of private financial assets, but also as a harbinger of things to come. Governments have shown a propensity to own more private sector financial assets. At the very least, they have incentive to add to their positions in adverse circumstances, and once they do, it's hard for them to sell down their positions because it's disruptive and potentially adverse in its impact on markets. It's not unreasonable, therefore, to think these percentages could be higher in the future. Thanks.